de la Reserva Federal. Es un placer saludar a Jay Pelosky, es el fundador de TPY Advisory. Jay, thank you so much for having us a few minutes. Jay, we already have on the table the decisions of three of the major central banks in the world, the Fed, the ECB, and the Bank of England. What is your opinion on each of them? Jay, we can't hear you. I don't know if you have your microphone on.
Yeah, sorry about that.
Okay.
Can you hear me now?
Perfect. I
Yes,
can. Yeah.
My fault. I think in addition to the three that you mentioned, Martha, we also need to bring in the PBOC, the People's Bank of China, which, as you know, recently reduced its reserve rate requirements. So the PBOC is easing, and I think will continue to ease to support China's growth in 2022. The Fed has now made clear what I think virtually everyone expected, namely that it's going to accelerate the taper and look to raise rates 2, maybe 3 times next year. And then we had the Bank of England and the ECB kind of also doing what folks expected them to do. Well, I guess the Bank of England was a little bit of a surprise, but I don't see that as being as important as the ECB, which again, I think kind of met market expectations. The Fed, which I think did a great job, clearly met the bond market expectations. There was no real reaction on bonds. And in equities, it was very much a sell the rumor, buy the news kind of event, which funnily enough was the topic of my musings last Friday. Sell the rumor, buy the news, and that's what investors did yesterday.
Mm-hmm. And that's the resume. Let's start with the Fed. On Wednesday, Powell announced it will be reducing net asset purchases in $30 billion a month, and the market reacted positively. Why was that?
Well, I think the market is not focused so much on the taper of the purchases. I think the Fed has signaled for some time it was going to do that fully in the price. And then the dot plots, which people pay a lot of attention to, signaling where the various members of the Fed committee thinks rates will go, synced up perfectly with the market expectations. Markets were already pricing in 3 rate hikes for next year, and that's what the dot plots also suggested, that the Fed is likely to raise rates 3 times next year. And so I think there was kind of an expectation that's been met. And now from the equity market perspective, the single biggest risk when investors are asked what is the biggest risk for 2022, they say a policy mistake. And the Fed has kind of taken the risk of a policy mistake off the table, at least for the next 3 to 6 months. And I think that provides a nice opportunity for equities to focus back on things like growth, like earnings, which I think are going to be very strong. And then two last points. One on the dollar, it could mark the peak of the dollar. And if we have a slightly weaker dollar, that's very good for risk assets. And then the last point is that even with the Fed raising rates several times next year, real rates, so after inflation, are still very negative and will be very negative. And that too provides support for risk assets.
Powell acted just the way the market wanted him to, but was it the correct move?
I think it is, because at least the tapering is, because by speeding up the tapering, it means the taper will end in March. And that will allow the Fed time to assess where inflation is at that point. To me, it's very interesting that the Bloomberg consensus has inflation peaking in the United States in December at roughly 6.8, maybe 7%. And then by the March, April of next year, the consensus of the top economists in the United States is for inflation to fall back to 3%, in large part because of what's known as the base effect. Big numbers falling out of the calculation, the year-over-year calculation, almost mechanically is going to bring inflation down much closer to the Fed path. And so I think giving the Fed time to assess where things really are in March, April, and May is probably going to be time well spent. And so I'm of the view that there'll be the most will be 2 rate hikes, not 3, that the 10-year is going to yield somewhere close to 2% by the middle of next year, and value and cyclical stocks are going to outperform in the United States.
Do you believe Jay Powell sounded too optimistic in spite of Omicron?
Omicron is, I mean, it's like this market, Martha, there's always something, right? Always a worry. It's really a market that has climbed the famous wall of worry. And the latest worry is now Omicron. And it is worrisome because it seems clear that it's very transmissible. The question is really severity and implications for hospitalizations and fatalities and deaths. And that's less clear. And so I think the market is going to be kind of hesitant. Typically, we have what's called in the United States a Santa Claus rally in the last couple weeks of December. I would still expect that to happen. As I said, I think the Fed decision yesterday has taken away a major risk for equities. So equities should start to focus in on very good earnings. Fourth quarter nominal GDP in the United States is probably going to be close to 15%. When you add real growth of currently tracking at 9% year over year and 5% inflation, you get about 15%. That suggests very strong earnings. And so if Omicron turns out to be transmissible, but more mild in terms of its effects, so fewer hospitalizations, fewer deaths, I think you have an opportunity for the market to do very well. If it turns out to be much more dangerous, not only transmissible, but also generates many more severely sick people who need to be in the hospital, be in ICUs, be intubated, etc., that's going to be a headwind for the markets.
And what about the Bank of England? Was it right to increase the interest rates in the UK despite it being the country with one of the highest infection rates with Omicron?
Yeah, no, that's an excellent question, Martha, and I think we'll have to see how it plays out. I mean, the UK clearly has a major challenge in dealing with a surging caseload, and then you have, as you point out, the Bank of England I think very gently tapping the brakes with a 25 basis point increase in rates. I think it's much more, markets are kind of now in the mood or understanding that we're now in a tightening cycle. It's a transition I was writing about 3 or 4 months ago, transition from liquidity-driven markets to earnings-driven markets. So investors shouldn't really be surprised that the Fed is tapering, that the BOE is starting gently to raise rates, that the ECB is likely to end its pandemic support early next year. But again, the important point from a global investment perspective is that the PBOC, the Chinese central bank, is more towards the easing. So when you balance out net on a global basis, I think you're still have a decent amount of liquidity, which that liquidity, again, supports risk assets like equities. And in that environment, the PBOC is much more important than the Bank of England.
And today, ECB decided to take a more conservative stance and only a short PEP will end in March. Do you think this was the right thing to do?
Yes, I think central banks would really like to get back to a more traditional environment where they can stop using some of these extraordinary measures and start focusing back on more traditional things like interest rate structures. And I think for sure in Europe, the European monetary authorities would love to get back into an environment where they had a real yield curve, where it was even nominally rates were positive. I mean, you have the 10-year German Bund, which is kind of the benchmark for Europe, still is trading at like minus 35 basis points. It's not even a positive number in nominal terms, let alone real terms, right after inflation. And so I think that central banks are hoping that we have a period of above trend growth and declining, but still above trend inflation, that we get into a better growth path in the US, in Europe, in Asia, than we had from the great financial crisis, right? 2010 to 2020 was not a particularly robust recovery. I think there's a chance 2021 to 2025 in US, Europe, and Asia for a stronger growth recovery, a capex boom as we deal with climate, consumer demand, and still underpinned by that negative real rate environment, which provides support for risk assets. That's the bull case, and very few people are talking about it. And I think that's what has a reasonable shot of actually occurring in the next couple of years.
Jay Pelosky, thank you so much once again for your time.
Great to be with you, Marta.
Con ese análisis de los principales mensajes de estos